thank you for joining us today. My name is Kim Hunredson, and I am a partner in our exempt organization tax practice, part of our Bailey National Tax Office. And I'm joined today by Christine Perez. Christine's a senior manager in our National Tax Office who also works with exempt organizations. And we are going to talk today about different types of organizational structures related to exempt organizations. And, this topic really came about because we see and get involved with a lot of organizations who, for a variety of reasons, might be thinking about either changing their organizational structure or entering into new activities and want to understand what impact that might have on their tax exempt status, what the right structure will be for them for both legal purposes and tax purposes. So we're going to go through today kind of an overview of the why. Why would organizations maybe think about some of these different structural changes, common types of entity types, just to make sure we're all on the same page with respect to legal structures that we might be talking about, how those various structures impact the exempt organization, and then some examples of things that we see, how we typically might see different entity structures coming about. And then we'll conclude with just some general considerations. So Christine and I will kind of jump back and forth. And like Amy mentioned, if you have questions, please feel free to put those in the Q&A or the chat area. We probably will wait and address them at the end, unless it's something that we can address right away, or if we can't get to them at the end, we will definitely reply to them offline. So with that, we'll get started. And we'll start with kind of an overview of this structural context and why organizations might be thinking about some changes. So we've put together about 6 different things that we typically talk to clients about, and these tend to be the biggest factors that come about with respect to why you might want some kind of a new structure. So the first one would be to protect tax exempt status. So if you are already a tax exempt entity, you're required to operate in accordance with whatever that exempt purpose is for which you were granted tax exempt status. So organizations might start to think about doing other activities that don't fall within their tax exempt status, and doing that can result in a loss of tax exempt status. The different types of entities have different types of restrictions. Now, most entities that we tend to work with are 501c3s. So the types of things that can jeopardize that 501c3 structure or exemption that might trigger us to think about doing something different would be not operating primarily for an exempt purpose. So if an entity starts to do activities that are unrelated to its exempt purpose, that can impact their tax exempt status. And that's a common situation where we would suggest looking at another organization to conduct those activities. Christine's going to talk a little bit in a few minutes about unrelated business income, which is really the concept we're talking about here. Private benefit. So 501c3s can't operate for the benefit of private individuals. So when we start to see activities that could put us into this private benefit type thing, that's where we might want to look at something different. Inurement, which is really operating with or providing a benefit to people who are in a position to exert substantial authority over the organization. If an organization is doing that, that can jeopardize their status. Now, we don't see this coming up too much anymore because there are some rules called the intermediate sanction rules that instead put penalties on those individuals who are benefiting from the organization. But places where we might see this come into play is excessive compensation or non-fair market value transactions. Political activities, C3s are prohibited from doing political activities. So if you have a C3 organization that wants to do political, that might be an option for them to set up a different entity. or substantial lobbying. C3s can do some lobbying, they can't have that be a substantial part of their activities. So again, a reason where they could see some kind of a new entity set up. We just put here, I think everyone probably, these are pretty self-explanatory, but if you lose your tax exempt status, there's some pretty big impacts there. So you're going to start to pay tax. You have that inability to receive charitable contributions. All kinds of other taxes could be impacted at a state level. And you could start to have issues with endowments or your restricted assets. So it's really important that if an organization is starting to see some of these activities being contemplated or occurring, that they're cognizant of that and thinking about how can we change that structure. It could be that we want to reduce our liability exposure. So maybe the organization is doing some kind of activity that has the potential to jeopardize the assets of the organization. So an example here might be, we've got some churches that we work with that have daycare centers. So they might choose to put their daycare into a separate legal entity because if something tragic were to happen within that center, they don't want all of the church's assets to be subject to creditors or to some kind of a lawsuit. So a lot of times what we see here is this ability to restrict liability becomes a driving force for thinking about a new corporate entity. Coordination between entities, especially in the last couple of years with everything that's going on in the world, we are starting to see more nonprofits looking at how could we do things better, more efficiently, more effectively. And sometimes that might be working together with other nonprofit organizations. Maybe two organizations see that they could expand their mission much easier if they work together than by working separate. Maybe you could reduce competition for financial resources. So there's some foundations who might say, you know, I'm not sure we can give a grant to two different organizations to do kind of the same purpose, but how about if we give it to you in some kind of a collaborative arrangement? Economies of scale. You know, we're starting to see more organizations that are sharing space, that are sharing other types of resources, maybe sharing knowledge, skills. Maybe two organizations can't both afford to have the level of a CEO or executive director, and so they decide to share that. So those types of coordinations can be very informal, or they can result in a more formal structure. Outside investors and compensation, this might not be something a lot of people think about, but you could be a nonprofit or an exempt organization that has some kind of an activity that you're conducting that has the potential for capitalization or investment. And as a nonprofit corporation, which we'll talk about a little bit later, one of the unique things about a nonprofit corporation is they don't have the ability to have owners. So you can't have stockholders of a nonprofit corporation or exempt organization. So the ability to get others to capitalize the venture or to help you to grow that activity may only come if you can set it up in a structure that allows for outside investors. And then access to additional compensation options. So exempt organizations are definitely able and should be paying compensation to their employees that's reasonable for the services that they're providing, but it can't be excessive. And so there's very strict guidelines with respect to making sure that compensation doesn't become excessive. If you think back to what I mentioned a few minutes ago on that inurement, this is where we can see excessive compensation coming in. So being able to structure an activity in a different type of entity may allow for higher compensation to be paid. And there's different types of incentive models for compensation that can be used in other structures. And then lastly, there could be some charitable deduction considerations. So it could be that an organization is going to or wants to conduct some kind of activity that they themselves could not get charitable contributions for, but by setting it up into an exempt entity or by having it conducted by an exempt entity allows for that entity to get charitable contributions. And Christine will give a couple examples of some of the scenarios where we've seen that come into play.
Thanks, Kim. So as Kim mentioned, UBI is one of those kind of big issues that does become kind of one of the common factors of why we see entities often determine, what's the appropriate entity structure, or looking at choosing an alternate entity or a separate entity. So when we think about UBI overall, it's going to have three main factors. So UBI is typically gross income that is from a trade or business that's regularly carried on, and it's not substantially related to the furtherance of our tax exempt purpose. So, really we're looking at those three tiers. We need to see a profit motive. We need our activity to be done regularly, and it doesn't otherwise, kind of meet our mission. So, typically when we think about this, a lot of times the first two items are pretty self-evident. But the third test, where it's not substantially related to our mission, that's typically the piece that we spend more time doing an analysis on. And that's usually where organizations spend some time determining whether we really do need to split out as UBI. So an organization can overall have multiple UBI pieces. So we can have multiple activities that are conducted by an organization that constitute UBI, so long as they're not regularly carried on or substantial to the organization. And when we talk about substantial, oftentimes, we'll kind of have this 15% number thrown around. So when we talk about UBI overall, the IRS hasn't come in and said, that there's a bright line test, that there is a specific cutoff for when the UBI of an organization becomes substantial and impacts tax exempt status. So, where we see concerns, and that's kind of based upon, what we've seen in case law from IRS rulings and PLRs, is, we start to see some concerns around that 15% mark. So 15% of the gross income of an organization. So once we start to exceed maybe that percentage of gross income, our organizations are starting to take that standpoint of, does this need to be split out into a separate entity? Does UBI need to move into a subsidiary? So this slide has a couple of just the main types of UBI, or where we might see some of these sources. As you can see, a lot of times it kind of follows along with, if a business activity is commercial, that typically tends to be, where we start thinking, are we doing something that really is our exempt purpose? Or are we doing something that is in direct competition to other for-profit businesses? And if you're starting to answer yes, this is probably an area where we want to start to look at the UBI. We also see alternate investments come through a lot. So that's where, we have an entity and we start to see the K1s come through. So those partnership K1s that come through that can report some activities that could be related. But we want to go through and take a look at these pieces. And, when we talk about unrelated business income overall, I think the slide before, we actually did have a line for siloing. So siloing is, the new regulations under 512A6. And we just kind of want to mention it because now our organizations are required to essentially silo our activities. So if they're related, they can kind of be grouped in one silo. If the UBI activities are unrelated to each other, we're seeing separate silos set up. So if we were just to look at this chart, if we've got advertising UBI, it's probably in a separate silo from if we've got pharmacy sales. And when this occurs, kind of the issue is that previously an exempt organization could take these and they could dump them all essentially into one pot, one bucket, and they could offset if you had income from UBI and a loss, right? But now we've got an issue with the 512A6 rules where it requires a separate calculation of each unrelated trade or business. And the concern is that an organization that previously in the past did not have UBI to report overall because of the offset may have UBI going forward due to these siloing rules. So the siloing rules, the final regs on that came out December 2nd of 2020, and they apply for tax years beginning after this date. So of course, we're seeing these final regs for siloing really are impacting as of most of our organizations in 2021. So it's kind of a big deal. We've got a lot of clients that are looking at these for this year's filing, for the 2021 filing, to make sure that they've got everything categorized correctly for UBI. And our next slide here has a couple of exclusions from UBI. So in general, under section 512B, we've got exclusions for a lot of our our passive income areas, if you will. So interest and dividends, royalties, annuities, certain rents. Of course, there's always those different rules for debt financing or mixed use property, and certain gains and losses from the sale of property. We'll note that if you have a S corporation, so if you've got an S Corp K1 that comes through, these exclusions do not apply as they would with a partnership K1. And then really where this kind of leads into with our discussion of UBI is a lot of time kind of this discussion of control. So it's a special rule implemented by federal tax law. So if we didn't have the special rule, we could potentially see exempt organizations taking their UBI, putting it into a subsidiary that then would pass up this passive income or non-taxable income to the parent. So in that case, we would have an issue where you've got a system of tax avoidance. So taking UBI, putting it in a subsidiary, then having the subsidiary pass up interest or dividends that would not be subject to tax under 512B. So the IRS kind of put the kibosh on that. And we've got these controlled entity rules under IRC section 512B13 that essentially say if an exempt parent entity receives passive investment income from a controlled entity that's a taxable subsidiary, so a partnership or a corporation entity that is controlled, it's going to be treated as unrelated business income to the parent. And when we talk about control, it's that 50% standard. So if we're talking about a corporate entity that's our subsidiary, control typically means ownership by vote or stock by more than 50%. And if we're looking at a partnership, you're looking at your K1 to determine if you own 50% or more of the capital interest or the profit interest in the partnership. So once we see it over 50%, we've got a situation where those passive investment income types that we would normally exclude are actually treated as UBI at our exempt organization parent level.
Great. And Christine, I just want to, before we move on to the next section, just a couple clarifying things there. On this slide, on the transfers between related entities, it does not apply to dividends. So dividends is your normal way for a taxable corporation to get funds back up to its exempt parent. A corporation isn't allowed to take a deduction for dividends. So therefore you don't have the ability to take get the double side. And then an example, so just to kind of put some clarity around it, would be, let's take a situation of an exempt entity that owns a building and they choose to rent that space to their taxable subsidiary. So the taxable subsidiary is going to take a deduction for rental income or for rental expense. And without this rule, the exempt entity would have rental income, but they wouldn't have to pick it up as taxable income. So now all of a sudden we get this benefit of a deduction down at the corporate level that is basically just a passing of income between two entities. So that's really the reason these rules are put in place. So if you have management fees or you have other types of service fees that are normal fees, those don't fall within here. You still have to analyze those for UBI, but it's really these passive things that organizations could put in place. And then the other clarifier I just wanted to, when we're talking about the 15%, we always start with the gross receipts. Other factors can come into play there too. So you can look at the amount of time that you're spending on an activity, the amount of your resources that go towards that activity. So even if the revenue isn't as big, if you have people spending a lot of time on it, the IRS could consider that to become substantial. All right, then we're going to move into some of these common entity types. And these aren't unique to exempt organizations. These are just very much the common entities. So general partnerships. So a partnership, there can be a general partnership and there can be a limited partnership. And in these types of entities, partners remain personally liable for the partnership debt. The income within a partnership flows through to the partners. So a partnership isn't actually a tax-paying entity. It's partners that are subject to tax on any of the activities of that partnership. And the benefit of a partnership is that it avoids double taxation. As we'll talk about later, corporations are tax-paying entities. So they pay tax at the corporate level, and then when they distribute a dividend, if they distribute to an exempt, they're not going to pay tax. But if they distribute a dividend to you or I, we pay tax on that. So a corporation has that double taxation. A little different, a limited partnership, the benefit here is there is some potential liability protection. So the limited partners have their liability is limited to their investment, where a general partner has unlimited liability, and you have to have at least one general partner. I would say we don't see partnerships used as much since limited liability corporations have come into play, but we do see partnerships probably more in some of the investment areas. So we have a lot of organizations that get involved in investment partnerships that are structured truly as partnerships. A corporation does provide for liability protection to its shareholders. The good thing about a partnership is you can transfer ownership fairly easily. So just like we can buy and sell shares of stock in corporations, that's a very easy transaction. Corporations have unlimited life. They are subject to more formal legalities with respect to how they're structured and how they have to operate. A normal corporation can't apply for tax exempt status. So a normal corporation is going to be subject to that corporate tax at 21%. And then, like we mentioned already, the income gets distributed up via dividend distributions. In contrast, there's the concept of a nonprofit corporation, and some states will actually call these non-stock corporations. But a nonprofit corporation, in essence, does not have any owners. It might have members, and those members might have some rights with respect to decisions that they get to control. Maybe they get to maybe the member appoints the board, but there isn't actually any ownership where any monetary ownership. There is protection of assets. So this is treated as a separate legal entity for liability purposes and other purposes. And nonprofit corporations can apply for tax exempt status. And this is an area that's often confused because people will refer to nonprofits. And typically when they refer to a nonprofit, in our world, what they're referring to is actually a tax exempt entity, but you can have a nonprofit corporation that hasn't applied for tax exempt status that is still a taxable corporation. So just because you're nonprofit doesn't give you tax exempt status. And then the last type of entity is a limited liability corporation. So as I mentioned, these have become much more popular. They're very flexible in the way that they can be structured. So limited liability companies do exactly what they say, is they limit the liability to the owner's investment in the company. You can have multiple owners in a limited liability corporation, or you can have one owner. It's much easier to have a limited liability corporation. You don't have to have articles and bylaws. Instead, you have an operating agreement. And limited liability corporations can apply for tax exempt status as long as certain conditions are met. And for many years, we knew that you could apply for tax exempt status based on some rulings as far as what those conditions were. In October of this year, the IRS actually released guidance in Notice 2021-56 that now lays out specifically what has to be in the operating agreement in order for LLC to get tax exempt status. And a lot of that is you have to limit the partners to being 501c3 entities. You have to ensure that the operating agreement restricts the activities to only exempt activities. I mentioned before, you can have multiple owners in a limited liability corporation or one member. So we'll refer throughout the presentation to single member LLCs. So that's, as it says, one entity that has one owner. And the beauty of these is, from a tax standpoint, is you get to choose how you want it treated for tax purposes. So in general, the default is that a single member LLC is a disregarded entity. So we'll talk about that later, but it's basically not treated any different than its parent for tax purposes, and its activities get attributed to its parent. Or you can elect to have it treated as a taxable corporation, subject to the 21% tax. Or you can have multiple members, and the default for a multiple member is to treat it as a partnership for tax purposes, or you can elect to have it treated as a corporation. So we get to use these structures and kind of figure out what makes the most sense for the organization. So now that we kind of know those structures, let's think about how various structures impact the exempt organization. And in this case, we're typically thinking about the exempt organization being the parent. So the entity that owns or manages or has the oversight over these entities. So if we have a taxable corporation or a multi-member LLC or a single member LLC that has elected to be treated as a corporation, their activities are not attributed at all to the exempt parent. So that provides complete tax protection to the tax exempt entity. So the activities that the exempt couldn't operate can sit in that corporation, and it's not going to jeopardize the status. However, as Christine mentioned, under those controlled entity rules, certain transactions with the exempt parent could result in tax. If we have a separate exempt entity, again, the activities aren't going to be attributed to the exempt parent. Each organization is going to file their own tax return. And again, you could have some of those transactions that are subject to tax if the subsidiary exempt organization has unrelated business income. If we have a single member LLC that's disregarded, its activities have to be considered as the parent's activities. So we have to look at the activities that they're doing and figure out if our exempt parent could do those same activities. And if they're doing something within that entity that could jeopardize tax exempt status, that's not a good answer. The beauty of a single member LLC that's disregarded is it doesn't have to apply for tax exempt status. It just gets tax exempt status, and it is eligible for charitable contributions. That's another ruling that came out recently, or within the past 5 years probably, that says you can make charitable contributions to a single member LLC. And then lastly, when we're talking about partnerships or the multi-member LLCs that are treated as partnerships, the activity of that partnership has to be analyzed to determine if it's going to be unrelated business income. I mentioned earlier, it's a flow-through entity. So you have to look at those activities as if the exempt parent were conducting it themselves. So that could impact your exempt status if that partnership is conducting activities that you as an exempt organization couldn't do. So if they have excessive lobbying, or if they have political activities, that could jeopardize the owner's or the parent's status, or if there's excessive UBI. The other concern that we have here is that when you enter into a partnership with non-exempt partners, we have to make sure that we're not jeopardizing the assets of the exempt entity. So we need to ensure that participation in that activity, in that partnership, is related to your exempt purpose, and that the exempt maintains sufficient control to ensure that the exempt purposes are going to be met. This is primarily when we're talking about situations where we are putting a large majority of our activities into this partnership, or a large majority of the exempt's activities is flowing through from the partnership. But if you're starting to think about transactions with non-exempt partners, we need to make sure that there's provisions in place to protect the exempt organization. All right, with that, Christine's going to jump in and start talking through some of the typical operating structures that we do see.
Perfect. Thanks, Kim. Yep, we're going to just kind of sideline. We're going to go through some of the more common operating structures that we see nonprofits employ. And of course, we only have an hour today, so we will move through a couple of these pretty quickly. And we're not going to cover every single, possible combination that you could see, but just the ones that we tend to see as we're working with nonprofits. So first, we'll kind of just talk a little bit about affiliation. And affiliation really can take many forms. So we can see anything from a loose affiliation where two or more entities are working together to on a project or for something that's exempt or assists the community, to we can see that affiliation take the form of a actual separate entity that is created for a nonprofit organization. So some of the common structures we see utilized in here are the partnership form, the LLC, the corporation, or the setup of another tax exempt entity. And some of those considerations are, when we look at the type of activity, will the activity be exempt or not? So if it's not, there's no real need to consider how much UBI that will flow through. But if we've got two tax exempt partners, do we have some UBI considerations that we need to look at? If we want to avoid a corporate structure that would be subject to the income tax, or do we need to look at a partnership or apply for an exemption for the nonprofit? These are all kind of different factors that we're going to consider. We're going to look at size in relation to the overall activities. So, if we're looking to protect our assets, we're going to need to consider, if we're looking at UBI, how big is this UBI activity? Is it small enough that it can be done by the original exempt entity, or is it so large or excessive that we're having to move it into a separate structure? And lastly, we've got tax status of the partner. So again, if we've got two exempt entities, maybe we're looking at, what's going to happen with the UBI. If one of the entities is taxable, we need to ensure and take a look and make sure that there's no benefits that are provided between entities. So different considerations depending on what entities we're looking at on the two sides of the affiliation. So our next slide kind of covers, and this is just high level on mergers and acquisitions. So sometimes we find that instead of working together or creating a separate entity, we've actually got two entities that might merge. And a lot of times we see this when we've got entities that are similar. So two 501c3s that are doing the same activity might decide to merge their operations to better serve their community. We see it a lot when they're trying to kind of do the economies of scale to reduce the administrative burdens or costs, essentially to streamline their activities by combining their operations. We might have a situation as well, if we're looking in a community, we've got two organizations that are doing the same thing. Is one of them failing? Or is one of them potentially going out of business and the second entity comes in and takes over in order to continue the provision of services to the community? Lots of different factors that may lead to kind of that merger or acquisition to occur. So when we do look at a merger or acquisition, typically one entity is going to survive. So one organization and its EIN will continue as the surviving entity. The entity that is merged in, that is typically, not always, but that's typically the entity that kind of almost closes up shop. So files the final 990 return, kind of moves or transfers its assets. That's the elusive Schedule N that sometimes we see when this occurs. And then eventually we end up with typically one Form 990 that's being filed that kind of encompasses the merged or acquired entities. Now we'll take a look at fiscal sponsorship arrangements. And, you know, a lot of times we see these with an activity or an organization that might be just getting started. This is also, you know, an option that we see a lot of organizations use that maybe say they don't have tax exempt status, you know, for charitable donations, and they want to utilize a C3 organization that does have the ability to give out those charitable contribution deductions under Section 170. So, you know, we might end up with a fiscal sponsorship arrangement for various reasons, for new organizations, for maybe a small project that's not going to go for a long period of time. We don't necessarily need to set up another entity. We want to use this fiscal sponsorship arrangement. So the way that these are set up is we typically have a charitable tax exempt entity, so a 501c3, that acts as our tax exempt sponsor organization. And we're essentially utilizing their tax exempt status so that, again, our donor can receive their charitable contribution receipt. So we see the flow of funds, you know, whether it's from outside sources such as, you know, public donations, corporate donations, grants coming in from private foundations, they go to that 501c3 sponsor organization. That sponsor organization will take the funds. They will typically retain control of the funds. So once those funds come in for that special project or exempt activity we're trying to do for the fiscal sponsorship arrangement, that sponsor organization has controls. It also has the obligations and the reporting a lot of times of these funds. So it's very important for our fiscal sponsors when they look at taking on this arrangement and performing this activity that they make sure that it aligns with their mission. So if we had a fiscal sponsor take on an activity that doesn't align with their mission and they're responsible for it, all of a sudden we have a situation where they're doing something that is not under their umbrella that they've applied for 501c3 tax exempt status for. So that becomes an issue. So we need our fiscal sponsors to be careful about the arrangements, but a lot of times these work really well for smaller projects, for organizations that maybe are applying for 501c3 status, need to do something in the meantime. So let's see, let's go to the next slide and we'll just talk through a couple of the different arrangement types and kind of examples of what we would see. So the most common fiscal sponsorship arrangement that we see is kind of, it's called this direct project. And it's really where the fiscal sponsor takes that project on in-house. So maybe it is, you know, a new project that they run, maybe it's kind of a different department or a program of the fiscal sponsor, and they keep it. So they've got the oversight. A lot of times they'll restrict the use of the funds specifically to that project. It would go on their Form 990. They would hand out the donation receipts. A couple examples that, you know, we can think of that this has occurred. So we've got a new nonprofit that sets up. They're going to be a youth hockey organization, and they want to do a fundraiser. And they've applied for 501c3 status, but they don't have it yet. So, you know, they're a little worried about giving out the contribution receipts. Well, they might team up with another organization in the area that's exempt under 501c3 to help them host their fundraiser. So the hockey team, they'll do the fundraiser. The 501c3 will bring all the money. And then as soon as they get their 501c3 status, they'll contribute it over to the newly formed hockey organization. These projects can last kind of for an indefinite period of time. Another example that we had was, you know, we had a local Rotary Club. So they're 501c3 and they took on a food program for schools. And so, you know, it was a good way to get the program started. But what ended up happening eventually was the program got so large that it needed to split off. But it was a great use of a fiscal sponsorship arrangement for many years, where we had the 501c3 entity kind of help run the program and take control of that until, you know, that food program for the schools was ready to go out on its own. So that was direct project. Another arrangement style that we can have is an independent contractor project. So again, the fiscal sponsor brings in the funds, they have the oversight of the funds that they're going to use, but then they take those funds and they give them out to, and we say independent contractor, it could be any other type of entity. And a lot of times we might see this with something such as an art installation. So a 501c3 nonprofit, they collect the funds. We're going to do this art project in a community space. They pay essentially the other entity or the independent contractor that's going to do the actual installation, but our fiscal sponsor still has control over the funds and the reporting requirement. Grant projects, these are a little bit different, but again, fiscal sponsor brings in the donations. So, you know, we're going to give out grants, they pull in the donations, give out the donation receipt, and then they go through the grant program process to give the grants out to the grantees. Now, once the grantee has the funds, the project essentially becomes actually the grantee is in charge of it. So the fiscal sponsor no longer has control once they give out the grant funds to that grantee. The grantee is going to do the project as assigned by the terms or outlines of the grant. Then group exemptions. You know, a good example for this one would be that we typically see used is the Roman Catholic Church. So we have one central organization that acts as the sponsor that has the 501c3 status. And by virtue of that group exemption, they give that 501c3 status to all of their subordinate organizations under them. So in this case, with the Roman Catholic Church, that would be each individual church at kind of the city level that operates under that large umbrella. We've put a note in here, the IRS is not currently accepting applications for group exempt status. So they are revising those rules. An organization that currently has this group exemption status is okay to continue operating as they are. They're just not taking new applications for groups at this time. And then the last model we see, this may be set up between two nonprofit organizations. And really what they're doing is maybe one smaller organization doesn't quite have the manpower to do everything. And they set up a fiscal sponsorship arrangement with maybe another nonprofit organization or another entity. And it's really to have assistance. So it could be anything from bookkeeping to legal to accounting services to management, where they're trying to share and receive that maybe at kind of a lower cost to make things really efficient for them. And we've got just a quick slide that's next that just really has a visual representation. I'm a visual person, so this kind of helps me when I'm thinking about it. But as I mentioned, the direct project really is where a lot of fiscal sponsorships end up with that program that is incorporated into the fiscal sponsor. So they'll take it on as a project and it will maybe become a program of the sponsor. So next, you know, when we talk about fiscal sponsorship arrangements, you know, there are a lot of questions that come up. What can we do? So we do see a lot of fiscal sponsors taking on the administrative functions for the programs, and they can go in and charge an administrative fee or kind of like take a little fee for these services that they are providing. A lot of times we do see it as kind of that startup phase. So a new organization that hasn't received their 501c3 status yet, or you know, we want to do something for the community, but we don't know that we necessarily need a separate organization for it. Again, the fiscal sponsor needs to make sure that whatever program or activity that they're performing is in line with its mission. So, you know, that's back to the 501c3 rules, where we need to make sure that we are following our tax exempt purpose. So if we are a fiscal sponsor that does an activity or program that is just completely unrelated to our mission, we start to run the risk or jeopardize our 501c3 status by doing that. And then again, it can be used for an indefinite period of time, but we'll always want to make sure that the organizations have contracts or agreements in place or have thought about what are the long-term impacts, and are we going to do this project forever? So, when I talked about the Rotary Club that had the lunch program, it was a case of, should they have had some sort of time frame or long-term implications or chart in to say, once you get this big, that's it, you need to split off. And a lot of times that can help organizations to kind of make that determination of when they are going to split a project into a separate entity, or if it will continue to be operated as a direct program of the fiscal sponsor. So our next slide, just kind of ties back into this where, what are the common errors that we see? So again, not aligning the mission, not considering, the past, present, or future activities of that program. Are you doing something that's not aligned with your mission? Do you have something that could be a PR or public relations problem in the future? Not doing the oversight. Remember, a lot of times with those direct projects, our fiscal sponsors are responsible. They have the reporting oversight. It's going to go on their Form 990 with a direct project. They are the ones responsible for giving out the donations. And so they can get in, a world of trouble by not doing that. And then again, having that clear exit strategy. So, if your organization doesn't want to be a fiscal sponsor forever, or you want it to be for a limited amount of time, these agreements need to be in place up front so that all of the parties to the agreement have clear expectations. So now let's jump into just a quick discussion on exempt affiliated entities. So this is another typical structure that we would see. So where we've got the setup of 2 or more affiliated tax exempt entities. And, really these are created to obtain the benefits of tax exempt status, oftentimes for an activity that they would like to conduct. They're created to separate our activities or to perform activities that can't be conducted under an entity's current exempt status type. And so oftentimes we see these set up as an LLC or a separate nonprofit corporation entity. And a lot of times our considerations are, if we're setting up a separate nonprofit, we've got to apply for tax exempt status, which if you've gone through it before, of course, it's a lengthy process that can get quite pricey with legal and accounting fees. And then we also want to consider how we're going to have those 2 entities structured. So are they going to share their resources? Are they going to share their space? Are they going to share their assets? Are they going to share the employees and the payroll? And, at the end of the day, when we're working with a 501c3, that's our top tier of nonprofit organization. And we need to make sure that that entity is protected. We also need to make sure that that entity is, a lot of times we call it, being made whole. So when we have these exempt affiliated entities, a lot of times we are worried about the transactions with that 501c3. So we'll run through a couple of examples and kind of chat about that. So our first example here is an example of where we would set up this affiliate relationship. So we've got a 501c6, a business league or association. They're providing lobbying, they're providing legislative activities, everything that can be done, under this exempt status type. So the issue here is, if you're a 501c6, you technically cannot receive tax deductible contributions under Section 170. So if we've got, I'm in Boise, so let's say we've got the Boise Association, and we really want to start giving out scholarships to our local college or university. Well, the issue as a 501c6 is we can't have our members, get a tax deductible contribution and give out those scholarships. So we might here look to form a 501c3 organization. That 501c3 organization would allow us to go ahead and accept the tax deductible contributions and set up that scholarship process and procedures under 501c3. And then our next slide covers affiliate relationships, maybe where we're looking at 2 tax exempt entities that don't receive charitable deductions. So this would be a case of, we've got a C6 and we're going to set up a PAC under 527. We've got a social club, and we need a separate title holding company to hold their property. Or we've got a labor organization under C5, and we need to set up the employee benefit funds here, or we need some pension and retirement funding, or it could be a voluntary employee benefit association or a VEBA. So these are different relationships where, we've got an entity that's tax exempt, and we need to set up a separate entity structure that is also tax exempt to perform a separate activity.
Great. Thanks, Christine. I'm going to wrap up our entity types by talking about disregarded entities and corporate structures. So we mentioned disregarded entities, or so the single member LLC. Typically, when we see organizations looking at using a single member LLC, it's primarily because they want to insulate the assets of the exempt entity from liability. So they get that liability protection from having the activity in the separate LLC. As I mentioned earlier, that activity, when it's treated as a disregarded entity, that activity is treated as if the exempt parent were operating in itself. So it's really, I always tell people, think of it as a department. All of its activities are going to show up in the financial statements. They're going to show up on the tax return. We need to think about them from UBI standpoint because they really are just like their the parent's activities. We could get to a point where we change the status. So we could, in the future, if we think, we would be better off having other entities that are partners in this. We want to have other members. We can then check the box and say, we want this to now be treated as a taxable corporation. And in that case, we can start to add other members. So again, this is a very flexible structure. The owner's tax exempt status flows right to that disregarded entity. So they don't have to apply for tax exempt status. They get the charitable contributions. So this is a really nice structure when you're thinking about that liability protection. And it's a kind of a half step between setting up a whole new taxable entity and having it still be treated as part of your exempt organization. And then taxable subsidiaries. So we typically are going to see an entity set up a taxable subsidiary, either a corporation or an LLC that elects to be taxed as a corporation. We're going to see that when we have these unrelated business activities that might be getting substantial, over that 15% threshold, where we say maybe just to make sure we don't jeopardize tax exempt status, we drop that into a taxable subsidiary. It really, from a tax standpoint, doesn't change the overall taxation, because if an activity is unrelated business income at the exempt level, they're paying tax at 21%. If we drop it into a taxable subsidiary, it pays tax at 21%. It's just a matter of not jeopardizing that tax exempt status. This can also be used to insulate assets from liability. It could be, again, an entity that we think there might be other people who would be interested in having an ownership in this corporation. And so maybe we've got employees that you could offer ownership to the corporation. Maybe you have outside investors. So the exempt is a partial owner, and you have other entities that own a portion. We sometimes see these being put in place when we're entering into investment partnerships and we want to kind of isolate the flow through activities. We know we're going to pay tax on it anyway, so why not put it into the corporation, and then all the activities of that partnership, if they start to do things that we couldn't otherwise do, they get hit at that corporate level. Sometimes when we have foreign activities, we'll see these, and they'll be called blocker corporations that get put into place. Compensation, I mentioned that earlier, as one of the benefits of these types of structures is that you actually can offer different types of compensation that exempt organizations may not be able to. And then when we look at some of the considerations here as to, is a taxable subsidiary the right choice? Control and ownership. So the exempt is going to control the entity to the extent that it has more than 50% of the ownership. That allows them to kind of control the board, control the officers, but it's really important that these two entities operate separately, because the IRS will look at it and say, if there's not a real activity going on there, if there's not oversight by a separate board, by separate management, well, then really this is just a way for the exempt to try to shift liability without actually setting up a true organization. So Christine's going to talk and go through some examples, but it's really important that you have actual separation of the two entities. You can capitalize the taxable subsidiary with exempt organization assets. There can be sharing of resources, so sharing of staff, sharing of facilities, but again, we need to make sure the exempt organization is made whole. So we always have to protect the exempt organization. Again, dividends are paid out, so that's how you get money out of the corporation and back up to the exempt owner, is that dividend. No deduction at the corporate level and not treated as UBI at the exempt level. If our exempt entity is a private foundation, there are some excess business holding rules that can come into play. So private foundations are a whole different area. We aren't getting into that at all today, but just know that if you are a private foundation and you start looking at some of these subsidiary structures, there's some additional private foundation rules that have to be considered.
Thanks, Kim. We'll just run through with our last minute here just a couple of other considerations to take into account when you're setting up separate entities. And the first one is state tax issues. Really, when we think about state tax considerations, are there exemptions from either sales tax or property tax that maybe apply to your nonprofit organization as a tax exempt entity that are not going to apply to the subsidiaries? So that's always kind of a fun surprise to people, but it does not, a lot of times these state exemptions don't apply to every organization within your structure. It might only apply to, say, your 501c3s at the state level. The other issue to watch for is just making sure that if you do choose a legal entity structure, that it is a viable legal entity structure in your state. So across the 50 states, not all of the rules are the same, say for LLC setup and things of that nature. With liquidation, kind of the key point here is if you're working with an exempt entity in a partnership, typically it's not a taxable event with liquidation. But when we have a corporation, and the real issue here is getting those assets back out once it liquidates. So organizations a lot of times can run into this issue when they close up or liquidate the taxable corporation, because that liquidation of the taxable corporation to the nonprofit entity is a taxable transaction. So that's a little surprise there, because if you're doing two for-profit taxable corporations, it's not an issue, but when we have that tax exempt entity, it does cause that issue with the tax upon liquidation of the corporate subsidiary. And then, when we talk about the relationship between entities, again, we're maintaining that separateness of the two organizations, making sure your nonprofit is whole, maintaining separate books and records. And then, when we talk about the relationship, just going through and making sure that you've got it documented. So if you've got two entity types and you've got transactions between the two, making sure that you've got those written agreements in place up front. And then I think I'll hand it back to you, Kim, and we'll wrap up here. And then we can't hear you. There.
Yeah, so thank you, everyone. I know we went through a lot of material today. Hopefully, it at least gave you an overview. Always happy to answer additional questions at this point if anyone has any additional questions. Otherwise, Christine and my contact information is in the slide. Please feel free to reach out to either one of us with additional questions, and we're happy to answer those. Or I guess we can look at if there's any questions that came in here, Christine, that we can address. So there's a question here with respect to a museum that's renting out event space to the general public that really doesn't have anything to do with the museum. So the museum's typically closed or not accessible during those events, and just questioning whether that could subject the organization to some concerns with either property tax or and unrelated business income. And I would say, yes, you potentially have concerns there whenever you're using space that's not for your exempt purpose. You probably are going to end up with unrelated business income there. There's some exclusions with respect to rental. So we have to look at whether it's strict rental or if there's other services provided too. And then from a property tax standpoint, it really depends on where you exist, whether some jurisdictions will look at if you're using part of your building for non-exempt purposes, they could carve out a portion of that and subject it to property tax. We've seen that happen a lot in the hospital area, where if hospitals are renting space to other entities that are for-profit entities, the jurisdiction will try to carve out that portion and treat it as subject to property tax.
Yes, and we've got a second question in here that just asks to go over rent in context of excessive fair market value. And Kim, you can jump in, but I'm thinking of this, if we've got a nonprofit organization that's got a rental contract set up either with another nonprofit, say like a 501c4 or a subsidiary entity, really the main point is we have to protect that 501c3. So if the 501c3 was to go out and create a rental agreement with a non-associated organization, what would they pay? What's the fair market value? If they pay over fair market value, do we have a private benefit or private environment consideration that would be bad, essentially, for the nonprofit organization? So typically, if we do have these agreements, we want to keep the nonprofit entity whole, and they should be paying fair market value or less in those transaction types.
Okay. And then we have a last question here. We are a foundation set up for scholarship development for a community college. College provides staff time to the foundation. If those foundation staff directly report to college staff, does that jeopardize exempt status? And that would not. We see that structure quite a bit. And a lot of times, that gets treated, maybe the college is actually donating the services of those employees to the foundation, or there could be a transaction between the foundation and the college where the foundation pays for those services. But again, you just need to make sure that it's at either at cost or fair market value. In a situation where you're talking about two exempts or governmental and exempt, there's less concern about that fair market value provision than there is if you were talking about a for-profit entity. All right. Well, it looks like we've answered the questions. So at this point, I think we can sign off. Thank you again for joining us today, and look forward to our upcoming webinars that are coming through our nonprofit series or some of our Inspired Perspectives series.